Hello everyone and welcome to my channel, where I share with you the best tips and strategies on how to grow your wealth and achieve financial freedom. In this video, I'm going to explain to you what is the snowball effect, how it works, and how you can use it to compound your wealth faster over time. What if I told you that you can make money while you sleep, by investing in high-quality assets that generate income or appreciation over time? Sounds too good to be true, right? Well, it's not. Imagine a snowball rolling down a hill. As it rolls, it picks up more snow and becomes bigger and faster. Now imagine that snowball is your money, and the hill is your investment portfolio. That's the snowball effect. The snowball effect is based on the concept of compound interest, which is the interest earned on both the principal and the accumulated interest. Compound interest is often called the eighth wonder of the world, because it can turn a small amount of money into a fortune, given enough time and a high enough interest rate. To illustrate the power of compound interest, let's look at an example. Suppose you invest $10,000 in an asset that pays 10% annual interest, compounded annually. After 1 year, you will have $11,000, which is $10,000 plus $1,000 in interest. After 2 years, you will have $12,100, which is $11,000 plus $1,100 in interest. After 3 years, you will have $13,310, which is $12,100 plus $1,210 in interest. And so on. If you keep investing for 30 years, you will end up with $174,494, which is more than 17 times your initial investment. This is how compound interest works. It makes your money grow faster and faster over time. However, if you only invest for 10 years, you will end up with only $25,937, which is less than 3 times your initial investment. This shows that compound interest takes time to work its magic. The longer you invest, the more powerful it becomes. This is why the snowball effect is also called the time value of money. The value of money changes depending on when it is received or spent. $1 today is worth more than $1 tomorrow, because $1 today can be invested and earn interest over time. How does the snowball effect work? The snowball effect works by reinvesting your income or appreciation back into your assets, which increases your principal and generates more income or appreciation in the future. This creates a positive feedback loop that accelerates your wealth growth over time. To use the snowball effect to grow your wealth faster over time, you need to follow these steps. Step 1. Start with a small amount of money that you can afford to invest. It doesn't matter how much you start with, as long as you start as soon as possible. The earlier you start investing, the more time you have to benefit from compound interest. Step 2. Invest in high-quality assets that generate income or appreciation over time. These can be stocks, bonds, real estate, businesses, or any other asset that has a positive expected return and a low risk of loss. You should also diversify your portfolio across different types of assets and sectors to reduce your exposure to any single asset or market. Step 3. Reinvest your income or appreciation back into your assets as often as possible. This will increase your principal and generate more income or appreciation in the future. You should also avoid withdrawing or spending your money unless it is absolutely necessary or for a specific goal. Step 4. Repeat steps 2 and 3 for as long as possible. The longer you keep investing and reinvesting your money, the bigger your snowball will become and the faster it will roll down the hill. By following these steps, you can use the snowball effect to compound your wealth faster over time. However, you should also be aware of some factors that can affect or limit your snowball effect, such as inflation. This is the general increase in prices and decrease in purchasing power of money over time. Inflation reduces the real value of your money and erodes your returns. To overcome inflation, you need to invest in assets that have a higher return than the inflation rate. Taxes, these are the fees or charges that you have to pay to the government on your income or capital gains from your investments. Taxes reduce your net income and returns and affect your compounding rate. To minimize taxes, you need to use tax-efficient strategies such as holding your investments for long periods of time, using tax-advantaged accounts such as IRAs or 401(k)s, or investing in tax-free or tax-deferred assets such as municipal bonds or Roth IRAs in U.S. Fees, these are the costs or expenses that you have to pay to the intermediaries or service providers that help you with your investments. These can be brokers, advisors, managers, platforms, etc. Fees reduce your gross income and returns and affect your compounding rate. To reduce fees, you need to use low-cost or no-cost options such as index funds, ETFs, robo-advisors, or online brokers. Why is the snowball effect important? The snowball effect is important because it can help you achieve your financial goals and dreams faster and easier than you ever thought possible. Whether you want to retire early, travel the world, start a business, buy a house, or anything else, the snowball effect can make it happen. The snowball effect can also help you achieve financial independence and freedom, which means having enough passive income or wealth to cover your living expenses and lifestyle without having to work for money. This can give you more time, flexibility, and opportunities to pursue your passions and interests, and live a happier and more fulfilling life. The snowball effect can also help you create a positive impact and legacy in the world, by allowing you to share your wealth and knowledge with others who need it. You can use your wealth to support causes that you care about, such as charities, foundations, education, health, environment, etc. You can also use your knowledge to teach and inspire others who want to follow your footsteps and achieve their own financial goals and dreams. Index funds can be a good way to experience the snowball effect. Index funds can enable compounding in two ways. First, index funds can generate income through dividends or distributions, which are payments made by the companies or securities in the index to their shareholders or investors. Index funds can reinvest these dividends or distributions back into the fund, which increases the number of shares or units that you own. This means that you will receive more dividends or distributions in the future, which can be reinvested again, creating a positive feedback loop that accelerates your wealth growth over time. Second, index funds can generate appreciation through capital gains, which are increases in the value of the shares or units that you own. Index funds can benefit from capital gains by holding the securities in the index for long periods of time, allowing them to appreciate in value as the market grows. This means that you will have a higher principal to earn interest on in the future, creating a positive feedback loop that accelerates your wealth growth over time. Besides index funds, which are a type of investment that track the performance of a specific market index, such as the S&P 500 or the Nasdaq 100, there are some other investment options that can enable compounding and the snowball effect, such as dividend stocks. These are stocks that pay regular dividends to their shareholders, which are payments made by the companies from their profits. Dividend stocks can generate income and appreciation over time, and you can reinvest the dividends back into the stocks to buy more shares or fractions of shares. This will increase your principal and generate more dividends in the future, creating a positive feedback loop that accelerates your wealth growth over time. Some of the best dividend stocks are those that have a history of increasing their dividends every year, such as the dividend aristocrats or the dividend kings. Real estate. This is a type of investment that involves buying and owning physical properties, such as land, buildings, or houses. Real estate can generate income and appreciation over time, through rental income or capital gains. You can reinvest the income or appreciation back into real estate to buy more properties or improve your existing properties. This will increase your principal and generate more income or appreciation in the future, creating a positive feedback loop that accelerates your wealth growth over time. Some of the best real estate investments are those that have a high demand and low supply, such as in prime locations or growing markets. Business. This is a type of investment that involves creating or buying a business that provides a product or service to customers. Business can generate income and appreciation over time, through profits or valuation. You can reinvest the income or appreciation back into business to expand your operations, improve your products or services, or acquire other businesses. This will increase your principal and generate more income or appreciation in the future, creating a positive feedback loop that accelerates your wealth growth over time. Some of the best business investments are those that have a strong competitive advantage and loyal customer base, such as in niche markets or innovative industries. These are some of the other investment options that can enable compounding and the snowball effect. However, you should always compare and evaluate different types of investments based on their returns, risks, costs, and suitability for your goals and preferences. The snowball effect is important because it can help you achieve your financial goals and dreams faster and easier than you ever thought possible. It can also help you achieve financial independence and freedom, and create a positive impact and legacy in the world. I hope you enjoyed this video and found it helpful. If you did, please give it a thumbs up and share it with your friends. And don't forget to subscribe to my channel for more videos like this. Also, let me know in the comments below what are your thoughts on the snowball effect and how do you use it to grow your wealth faster over time. I would love to hear your feedback and suggestions. Thank you for watching and I'll see you in the next video.